increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Test, test, test. Audio should be on. Test, test. Seems good. Are we going to come back? That's the question. What do you think, chat? World War III or fade it? Do we fade World War III? I think you do. Got about a minute here. 1 minute. Okay. All right. Let's rock and roll. Hey, can I get the return, please? Can I get the return, man? Good afternoon. Welcome to Chicago, Future of Finance. I'm Oliver Rinnick. We are live here from Cboe with an hour left into the close. It is perhaps the World War III trade, or maybe we fade it. Call me stubborn, but that's where I lean right now. The market's trying to power back here. Yesterday on my TikTok, give me a follow at Stay Solvent. I talked about fading crude and buying the dip on stocks. I was wrong coming into today, but I'm still feeling generally confident here that geopolitical events are pretty reliable sell-offs to fade. The VIX pop tells a good story today, very clearly. The volatility certainly is surging. Perhaps that's because folks are worried that we're going to be in a sustained war like Ukraine and Russia. I just don't think so, but here's the chart. Is certainly showing up here in a very big way. So to see the volatility regime that's been holding on here and extending is obviously concerning. That's not a good thing. We were hoping that VIX would break down from this line, but instead it's extending higher. Now, volatility, though, if you zoom out a little bit, certainly looks somewhat unsustainable generally at these levels. So I do hope that that's the case. If you look at overall stocks, the range has broken for the S&P 500. That much is definitely certain, but we're also not losing it too far either. Look at this as we push up to 68.27. S&P 500 touched below 67.20 earlier. You can see the candle down there. So the bounce back here is pretty decent. That being said, my main view has been the semiconductors are your guiding light, your general uptrend in the market that's been pretty darn hard to break. So I do think as long as that doesn't break, then you're in pretty good shape. You still have higher lows and higher highs for that chart, which I think is encouraging. Maybe I do need to rethink my risk radar a bit, but I'm holding the green light on stocks for now and yellow on everything else. And by the way, the caveat in my out is always, to use the poker term, an out, is the short micro strategy if you're going to be long risk assets. MSTR today down alongside everything else, but it's also trying to firm up a little bit. I do think also what's interesting is the dollar and bonds too. There's definitely an argument to be made that investors aren't buying bonds because they're worried about inflation implications. If you're going to get yields higher because crude is higher, that's a possible argument, but I'm not too worried about that either. I think generally still treasuries get bought if there's something very cataclysmic happening. So the small move in bonds today is fairly minuscule. Keep in mind that the 10-year yield has been moving down in a hurry. Perhaps maybe this is just the shakeout that we needed. Gold is also getting blasted. Today, that's very interesting. A lot of times people think about gold as a geopolitical hedge to own gold as an offset to these types of events. But gold getting hit today, I think, I do deserve some credit because I've been talking about the risk of gold now losing some of its inherent properties as a portfolio hedge because its volatility profile has gotten so out of whack given all the massive options buying flows and general exponential move in gold. So the fact that now gold is down today tells you need to be a little bit careful thinking about this as a volatility hedge. And then finally, generally, in terms of volatility hedges, look at the dollar. The dollar firming up pretty good. Strength in the greenback is fairly impressive here. I think that also tells you that the fact we can go in and take out big bad guys like Khamenei and Maduro with relative ease is pretty gung-ho USA, USA. So do you want to fade our military might? Do you want to fade the dollar? At this point, I think it's getting a little bit more difficult to say. The dollar has been a fade, but perhaps that's run its course. So in terms of volatility running its course, we want to, of course, check in with the volatility expert, Mr. Brent Kochuba, joining us from SpotGamma as we look at today's sell-off and the overall volatility landscape, which has been, I think, generally waiting for something, Brent. I think that you've more kind of cautioned that this could break down in price action for the S&P and maybe have another leg higher for VIX. But based on what you're seeing here today, Brent, does it look like we're shaking out some of the tension and volatility? Where do you start your analysis here today?
Yeah, hey, Oliver. So yesterday was interesting because what led the bounce higher was put selling. And it was put selling not of the 0DT flavor, and that seemed like some hedge monetization. Meaning I was long puts as a trader. I'm going to sell some of those on the initial spike. And just the general idea that every dip should be bought. And that pushed the market up. And then obviously this morning we broke new lows or recent lows. And we tested the bottom of this trend. We talked about the 6,800 to 7,000 box. Well, if you zoom out on that a little bit more, Oliver, you see that there's been a few very, very brief spikes to 6,700. And then we sort of rip right back. And this morning, we tested that 6,700 level. VIX got around 28-ish, which is a pretty healthy vol premium. And then interesting, what we saw was some longer dated call buying coming in. So that's a little bit of a different tone change today in that dip buying than yesterday. But here's the overall problem with this, is that you can't stuff volatility back in the box that easily. And the reason I say it is because we have one very big unknown, and that's the obvious war situation. And then the second one is this credit issue. Now, the Venezuela situation obviously was like, there was a action and then it was like, it was over, right? Now things seem to be arguably getting a bit worse. It's unclear. There's polymarket nuke markets now being made. I mean, look, it's a very, potentially ugly situation. It could easily get worse just as much as it could kind of get better, right? And the reason that matters is because you don't want to be sitting here short vol in that type of environment, right? I would argue that there's probably a lot of risk managers out there who are like, look, you're not sitting here short puts, short VIX call spreads when, we're on the precipice of World War III. I don't want to be too hyperbolic there, but I think that's the point. You think about bank failures, right, or those situations. These are moments where the known unknowns are pretty large, and it's clear we have a war going on. How unknown, are the events coming out? We're not sure, but the chances of something happening that's not in everyone's sort of risk radar, so to speak, is higher in this environment. And so what that means to me is we have to maintain a volatility premium that we didn't have to maintain, say, last week. And then just on the second one here, there are credit market moves happening that are quite interesting. One are related to the macro environment, so dollars catching a bid. So it's a very kind of tenuous situation right now, and I think the ultimate takeaway is don't think that the stable bottom is in. It may be, right, if we declare that the war is over tomorrow, but until we actually...
To add some chaos to the action, internet's taking some hits, but I think we're going to push through it. Brent, the market obviously had been having a lot of this single stock dispersion and some volatility.
At 40 like it was, or 50 like it was back in April. But the fact that put skew was elevated told us, or was a signal, that there was indeed some demand for put options into this event. And so what that essentially means is people came into this event. It was well hedged. I don't know that people were specifically hedging this. You know, in hindsight, you look and see all of the military hardware being moved to the Gulf over the last couple of weeks as a signal. You know, whatever that may be, people seem to have the ability to sell puts when the spike happened, when the vol spike happened and the market came down. And that offers market bounces, right? To the point yesterday where we saw puts being sold, and that helped the market to rally. Now, I still think that you need to maintain put hedges in this environment because of the unknowns. And so I think what that did is now the hedges have been rolled down and out. And the reason that that matters, you take a put, right, a 6,700 put, you monetize it for March, let's say. What do you do with that? Well, you buy a June put at a lower strike, right? And so that rolls your protection out. But what that means to me is that now we have a softer underbelly to the market. So there is another volley here, another round of risk. Now that 6,700 number becomes more susceptible to being kind of punched through because that same level of hedging isn't in place.
I see. Yeah, so it should have been a floor, but it broke basically. That 6,800 should have been that area we could kind of rely on to some extent, and we lost it. That said, we are fighting for it, Brent. I got your trace up right now, and I mean, you know, we're pushing 22.6 VIX, certainly not the high of the day. I mean, we're not giving up without a fight.
Yeah, vol absolutely collapsed back today. You know, we're above where we were yesterday, but VIX this morning was at 28 when the S&P was at 6,700, right? So people definitely bought that dip today, and it was some put selling, but some decent amount of call buying, not just 0DT, but some longer dated calls being bought as well. So that is a little bit of a healthier look than yesterday where it was pure puts being sold, and that was the big driver. And so if you look at that map, you see there's blue above, which is positive gamma, which tells me that 6,800 to sort of 6,830, that's probably a cap for today, I would guess. But that red underneath, Oliver, that's all what we call negative gamma, which means that if this thing rolls back over, there's nothing necessarily to support it. And I think to the point earlier of hedges being rolled, excuse me, things are a little more susceptible to downside now, to lower lows, I think, tomorrow or in ensuing days than they were, right? And that's the risk here. And on that point, I wrote in this morning's note, you know, there's no need to be a hero here and try to aggressively buy every dip. And the reason for that is overnight, one bad thing happens, right? One other party gets involved. One thing just doesn't go the way you think it does. And there's no reason that we're not down another 2 to 3%, right? There's just these known unknowns that we're facing that make it tougher to say, I want to really step up into this environment, right? I mean, geopolitics are hard enough if you read on Twitter for anybody to get right. You know, no one's ever really right there. And so I don't really want to expose my portfolio to a whole bunch of risk in this type of environment where there's not an obvious support level anymore.
Yeah, we cracked it, which is unfortunate. Hey, Brent, last point here is just for those trying to put on trades today, you know, vol is obviously is still pretty pumped up, so it's pretty hard. You have to do it as a spread if you want. Yep. Is there anything that stands out just very simply, kind of 60-second from the volatility structure that would make sense, either if you're bullish or bearish, your choice, kind of which one looks more obvious to you?
I think the only way to play upside right now to me is call spreads, more likely call flies, and that is because as the market rallies, vol is going to come in, right? So you got to offset that impact of options trades with call flies. So I think you could step out to, you know, later on this week or early next week with some 69, you know, 7,000, 7,100 type call flies, something like that, that as the market rallies and vol comes in, that structure hopefully does a little bit better for you. And then to the downside, it's a tricky situation as well. If you want to add new hedges now at this moment with the market over 6,800, it's a little bit easier than it was this morning. But again, put flies or put spreads, because that vol is a little elevated, is likely the way to go. So, it's kind of one of those moments where the cheap hedges or the cheap options plays on either side of the coin at the moment, they're gone, right? And so you really got to step into some of these structures as a way to play these various markets. And, Oliver, another thing to note, the software sector is looking good. And so, that idea that the bottom or short-term bottom came in.
I thought that was interesting too. Bitcoin too, both found some support today. Some of the most beaten up areas. I think that's kind of bullish.
Yeah, and then one ugly one, you didn't mention it yet, silver. Holy cow. So I'll say that, and then I'll sign
silver
off for
and
you.
Gold. We got
Silver's
Jeff
quite nasty.
Weniger coming up from WisdomTree. He's got some gold funds for us we're going to talk about. Brent, great stuff. Good analysis. Glad we pushed through that internet. Faith in Cboe internet. I got my Verizon, but it was spotty too. So I don't know what's going on down here. It's just too hot. Yeah. Hopefully we're not getting hacked by some Iranian coders or something. Thanks, Brent. Appreciate it. Good analysis on the VIX. As always, SpotGamma, nice work. Looking at the landscape here for volatility today. We got a special conversation when we come back. We're going to shift to something a little close to home here in Illinois, which is the Republican primary just a couple weeks away. I'll be joined by Ted Dabrowski, who for a while has been the preeminent voice on Illinois' economics through his publication Wirepoints. He's joining me here as a candidate for governor of Illinois running against Pritzker. That's up next on Chicago Future of Finance. 2.5-minute innovator buffer break, then we're back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% trap? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago. the future of finance. Join me, Oliver Rennick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago.
You just setting up all your pages? Oh, that's cool.
Welcome back to Chicago Future of Finance. I'm Oliver Rennick in an almost 10-year career covering markets. I hope the one thing I've stood out by is that it's always about the numbers. In my past job, we specifically had ads that said no politics. Today here on Chicago Future Finance, that shifts a little bit because I'm joined by Ted Dabrowski, who's running for Illinois governor here in Illinois, in Chicago, with a couple weeks away from the primaries. He's joining us here on Chicago Future Finance. Ted, it's great to have you.
Thanks for having me on. I appreciate it.
This is a big moment, obviously, for the state of Illinois. I think that from what I've seen so far, there is a lot of discussion about things that don't pertain to Illinois economics. The reason why I wanted to have you on the show is because my view and my research, and I think that anybody who does the research, you were specifically doing this research for years at your publication Wirepoints, will see that the Illinois story can be a pure numbers story on how far that we've fallen behind our potential. Tell me about how that factors into why you chose to run for governor.
Well, you know, when my parents came here 60 years ago, they were immigrants. My mom from Ecuador, my dad from Poland. Illinois was a beacon of opportunities, a massive growth state, and everybody was coming here. Now, people are leaving the state, companies are leaving the state. You know, we all know about Ken Griffin and Citadel leaving. We know about Caterpillar. We know about Boeing. So this is a big, big problem right now, and we got to get back to being a growth state because this is how you get opportunity, economic growth, job growth, wage growth. Without those, it's hard for people to prosper, and guess what? They leave the state.
The Wall Street Journal did a piece on you recently, the data crusader trying to save Illinois, and I thought this was perfect. I've known you for a bit. I've followed your work for a bit. Wirepoints spends a lot of time focusing on pensions in particular. I want to start there because the math that I've seen from you and others basically tells us that we're going to have in Illinois major problems within 5 years in terms of the funding behind the 3 or 4 of our major pensions. Tell me where we're at with that right now. Has that changed at all, or is that still a major threat to this economy?
Oh, it's a major threat to the economy. If you look at pension debts across all the 50 states, there's one state that sticks out like a sore thumb. That's Illinois. We've got so much pension debt, we don't know what to do with it. And Chicago in particular is very vulnerable. The police and fire pensions have less than 20% funding, so they are at big risk of going bankrupt. And you know, Warren Buffett said a few years ago, Illinois has so much pension debt, and a few other states, they have so much pension debt that he would never put a plant here in Illinois because they'll come after him for taxes for the next 30 to 40 years. That's the kind of reputation we got, so we have to address pensions by moving to 401k plans for all new workers and for all new government workers going forward.
Can you grow your way out of such a problem?
Well, you can try to grow your way out of it, but you know, who's going to come here? You know, when you've got states like Texas and Tennessee and Carolina growing like crazy, they're not putting the marginal dollar into Illinois. They're going to those other states, the companies are. And so you have to change how people think about Illinois before you can actually grow your way out of it. So that's why, you know, as governor, I will change the culture and, you know, start attacking the problems, bring property taxes down for companies, you know, get these pensions under control so that we can attract companies, so that we can grow.
There is something else that I've seen, which is that we're giving, ironically, for I think some would argue a Democrat governor, we are giving big breaks to corporations. Like I think about the Quantum Center, it almost feels like we're having to pay companies to come here. And ironically, then you have a situation where some of these corporations are getting really low taxes, and at least the last I checked, which was at the end of last year, was state and local tax rate in Illinois that was upwards of 15 to 16%. So we're giving almost, I think that's the highest in the nation.
Well, yeah, depending on how you cut it, you know, we're always in the top 7, and certainly some of them show we're the highest. And so this is the problem. We keep taxing people and then giving away breaks. And so you got our politicians like Governor Pritzker picking winners and losers. One of the big ones that he did was a company called Goshen, a Chinese EV battery manufacturer, Chinese controlled. And why are we giving them $500 million and then taxing everybody with the highest tax rates? It makes no sense. And so, yeah, we shouldn't have to bribe companies to come in Illinois. We're the sixth largest state. They should be dying to be here because we're growing, because we're thriving.
The thing that hits me too is that when I think about it from a market perspective, Illinois feels like the best trade in the continental U.S. in the union, because from a trading perspective, you think about potential value versus the price it's currently worth. We have water. We have nuclear power that, from what I understand, is still untapped. We've got land too. That sounds like a great recipe to do something like what, say, a state like Texas might be embracing. These data centers, AI. Can we become a hub for the future of technology?
I think we can. So we're in the center of the country too, right? The whole infrastructure, all the railway, all that stuff, AI and just business in general. We're the perfect spot. But we can't be, as long as we have too much debt and we continue to run and chase people away, chase companies away, chase people away. Companies want to be where people are. And if you look at the economic growth of Texas, Florida, Tennessee, Carolina, they're way above where we are in Illinois. We're a bottom 5 state under Governor Pritzker for economic GDP growth last 7 years, 5th worst in the country. Job creation, 5th worst in the country. Wage growth, 6th worst in the country. We can't, who wants to move there? We have to change that.
Numbers that are high up, right? Like,
well, we are
the basic resources of what a state can then deploy.
Yeah,
that spread is huge.
Oh, come on, we're over $1 trillion economy, so we're big. But again, you talk about where the marginal dollars go, because in the end, you know, I meet companies who are invested here, and they say they're taking all their money, investing it in other states. They will not invest the marginal dollar here, and that's a sad situation because they just don't see the growth here. And that's on Pritzker, and that's what I want to change.
There's a stat that I think this does come from you. Let me pull it up real quick. Chicago pension funds running out of money. This, I think, puts in perspective. This is the assets to annual payout ratio, and this is from WirePoints as well as Boston College research. And this shows teachers, laborers, municipal, police, and fire. Basically what it means is that, the way I understand it, when those numbers for the Chicago pension go to zero, that means we're going to have to start getting money from what? Day-to-day operations?
Just from the budget, yeah. If and when the pensions run out of money, you take it away from whatever the general budget is. You're talking about schools, you're talking about police, you're talking about fire, just the general operations, and potholes in the roads.
The comparison, which is insane, is that look at LA police and fire here. They've got, 20 years by the same metric? So
it would take them 20 years to run out of money. You've got other
so even
funds that are 30
California,
years. Yeah.
which is a state that has comparable population bleed and problems, we are, by this math, 4 to 5 times worse.
And this is what I scream about. You know, if you care about your policemen, which I do, I care a lot about the police, their pensions are broke. We got to do something about it. And you know what Pritzker did recently? He actually increased pension benefits. He actually made the problem worse. He's making promises he can't keep and making Chicago even more bankrupt.
That's a really important one, an important one to address, because doing so exudes a certain degree of confidence that pushes diametrically against this data. But it also, to your point, promises it gets money in there, but does it just push it back? Does it kick the can? Is it a ploy to?
If you promise more benefits, it actually makes the hole bigger because the city can't pay its obligations now. Pritzker and the legislature just promised even more. They don't have the money.
How much is a Chicago problem versus an Illinois problem? Are they the same?
They're the same. Chicago's might be more acute, and that's the risk. And if Chicago goes down, guess where Illinois goes? So we got to take care of Chicago, and Chicago's at big risk because of the crime issue. The schools are extremely poor. They don't, and I mean poor in terms of outcomes. They have a lot of money. The unions have a lot of power, but our kids aren't learning to read, and the families are going to keep leaving it. It's shrinking, and when you have shrinking schools, more crime, and not enough job growth, watch out. But that does create the great opportunity that you mentioned. It's a great buy, man. This place is amazing, but we have to switch leadership, switch a mentality to a winning mentality. We can be the best, and our politicians don't think about the competitiveness of Chicago and Illinois versus other states. They're more engaged in let's call it social justice programs. I want to compete with Indiana. I want to compete with Texas.
Yeah, I mean,
Florida.
heck, we're losing the Bears.
Yeah, well, that kind of captures, that tells you everything you need to know, right? It's gotten so bad that we could actually lose the iconic Bears. That's how bad it's gotten.
This shows Chicago Future Finance, and I do believe wholeheartedly in that. It is a very honest description of the show, because what's happening here is so crucial to really, frankly, the kind of global market macro structure, that this has been a success. The brokerage boom, the trading boom, and I wonder how much you've thought about, because if this is the future finance, which I believe it is, they're working on event contracts here, options are huge. It almost feels like this is a success despite the state in which it resides.
Right.
But is there a way to take what's happening here and find some leverage there, and to find some momentum? Maybe, I don't know what's going on behind the scenes, but maybe it's just going to these guys and saying, hey, we can make this better with your help.
I do think so, but I think we do have to change the culture, and we haven't changed it. We keep doing the same thing over and over again every year. More spending, more debts, more pension debt. Until we change that, it's people are worried, and investors are not going to invest in a place that continues to do the things wrongly. So that's why I'm running for governor, because I think we can do it entirely differently. You and I have talked in the past. I'll tell you my experience from when I was in Poland. I was in Poland in 1998 to 2007, and you saw the dramatic shift from socialism and communism to free markets and capitalism. Look where Poland is now. We can do the same thing in Illinois.
That's a very interesting comparison, by the way, because I've been to Poland. Mm-hmm. It's a very interesting comparison, because when you arrive in Poland, it is like people are great, but it's almost like it's still it's a war-torn country.
Yeah,
it very much is. I mean, they made a lot of progress. There's a lot of stuff there that is just Right now, Krakow is very different. Krakow kind of feels like Brooklyn, New York, almost, but it's a very interesting comparison, because what you're saying is that this is a broken state.
It's a broken state, and they had. We have real problems here, and of course we're not Poland. Come on, let's not exaggerate, right? But at the same time, in a place where you don't have that kind of that individual freedom, if you don't have that confidence, if you don't want to invest, then and we're headed the wrong way. So we have a huge chance to flip things, and I think we can do it. Like you said, we should be optimistic, but only if you change leadership.
What are the first things you do? First, you got to get through the primary.
Yep.
I don't want to get too much into the kind of political back and forth. Darren Bailey, who seems to be in front right now, has run before and lost. Mm-hmm. I don't know how that'll affect what happens in the primary, but let's say that you get the primary, you're up against Pritzker, you win. Let's say we get through all those things. Mm-hmm. What's the first thing you do? How do you start to turn this wheel around?
Well, there's a couple first things, and they're very different. One is you got to get the crime situation under control. The sanctuary city stuff, the crime stuff, we need to get control. So executive orders to end the Safety Act, end the sanctuary state, and get back in and have people feel safe. But after that, the big thing is to expose where all the money's going, right? A Doge type like program, because in Illinois people keep paying more and more in taxes, and yet they have no idea why we're always in deficit and why they have to keep paying more, and why there's always problems. So I want to expose where the spending is so that we can cut spending and bring it back to reality. Get these taxes down for both property taxes for both companies and people.
Okay. Hopefully it comes down to numbers. It does feel like of all of the states, the numbers tell a story here that is very objective. By the way, we also got our first credit downgrade again earlier this year.
There you go.
Chicago. He likes to talk about the credit upgrades, but it's a lot of COVID money, right?
Yeah, that was COVID money. Yeah, we burned through that. Now we're running out of money again, and here it comes. So, the facts matter, the data matters, and that's the starting point for any good discussion. Is you got to be able to acknowledge where you are. You got to rank yourself. It's like looking at the stats, any stats, right? Yeah. It's how you adjust your portfolio, you adjust your life.
Adjust the Illinois portfolio via Ted Dabrowski. I guess maybe the closest thing I've gotten to an endorsement in my career. But hey, I run my own show now. So, Ted, thanks a lot for coming down.
Thank you for having me on.
Appreciate your time. Best of luck.
Thank you, sir.
Appreciate the rundown, the numbers, the education too for myself over the years following wire points. Ted Dabrowski, March 17th. Polls, right?
That's right. Republican ballot.
In Illinois. Okay, great stuff. We'll be right back.
Thank you.
Chicago Future Finance.
Thank you, sir.
increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. I'm Oliver Rennick. It's time for the Chicago Board of Exchange Cboe Exchange Traded Profile. We're going to talk some gold today. I'm joined by Jeff Weniger from WisdomTree. As gold is having kind of a rough go of it here. Jeff, great to have you on the show.
Yeah, it's my pleasure. Glad to be here. Yeah, I think it might be a little bit of buy the rumor, sell the news here on the Iranian situation. And a little bit of a rough tape, I guess you could say here. Last I checked, we were something like 5,100 on the metal. We were at 54, maybe 24 hours ago. So
yeah, it's
have
getting
changed a little
cooked.
bit.
I guess when you look at gold, just going to pull up the chart here for context. You guys have got a lot of WisdomTree for sure, but today we're going to focus on gold. I do think it's a fun one, obviously, to focus on. But the chart has been just up and to the right, as a lot of people know.
Yep.
It's a beautiful looking chart. The thing that I've kind of argued here, and I want to start to get your thoughts on this, is has gold's volatility and past year or maybe 2 years of performance kind of changed its risk profile? Like, is this a different rock than it used to be? Because rocks usually don't move this fast. Am I wrong?
Well, it's been like 40 years since they started moving this fast, and then you had a lot of people wondering about January of 80 when the Hunt brothers cornered silver and that vertical type move that we saw in gold and silver. And now we've been taking a little bit of a sideways type breather here for basically a few weeks in the metal. But a lot of it boils down to as well this shift that we've had, and probably my guess is 99% of the people on the show talking about software and this analog versus software on and off concept. And to the extent that this new rock that's moving differently from other times, it's because there's this other thing in context of it, this piece of software that's called crypto that we didn't have in 1979 and into 1980. And I think that there's a lot of on-off going on between those two. I mean, look at this 6-month chart where gold's just doing this. And let's just take Bitcoin. Bitcoin's doing that, 120K down to 67-ish or something like that. So a lot of people having very, very different experiences in alts to fiat, I guess you could say.
So as people try, is this a fix the bond part of the portfolio? Do you view it that way? Because a lot of people argue that's kind of what these tools are doing. And I will say that it is kind of confusing to figure out on a day like today what bonds are doing. They're ultimately doing nothing.
Yes.
But maybe they should be. Because I think a lot of times if you're going to look at VIX moving, 10 points or whatever in a day, you're probably going to have treasuries up.
Yeah.
Today it took a while for them to rally.
Yeah, and I mean, it's because you can have various types of shocks, like Greek exit of a bank or something like that 15 years ago, or you could have a Bear Stearns hedge fund going under to go back at this point, 18 years ago, or you could have a Yen-mageddon or all these various shocks, but this is the classic 1970s style scare shock, Strait of Hormuz, oil shock, all these various things. So fixed income not rallying in this. You might have any other thing that's moving the VIX. I think we were early to 28 on the session on the VIX, maybe settling where we settled 22 or so, something like
22, 23. We'll see in the next 19 minutes if we ramp into the close here.
Yeah, and you'd expect 10-year T-notes to be, in any other type of shock, maybe down there at 390, 385 or something in a session like this, but didn't happen.
Yeah. Okay, so in terms of how you guys think about gold in your funds, a few that I want to pull up here that are, by the way, to start, they're dirt cheap. 20 bips.
20 bips.
The GDE, Gold Plus Equity Strategy Fund.
Yep.
Tell me the Gold Plus Equity side. I think that this also kind of fits in a theme where people want to see, we've had stacked ETF conversations,
Yep,
we've had
yep.
overlay conversations, of course. How do you guys do this?
It's in the stack conversation.
Okay.
And I think one of to back of the envelope GDE, it's essentially you got $1, you're getting 90 in equities, 90 in gold. And the 10 that's not the 90 is is the collateral for the gold futures. So you're essentially getting 1.8. So it's a know what you own, right? You don't want to be putting the whole portfolio into these things.
Okay.
But essentially if you're thinking about something that's like a 60-40, and you got $100,000 in the whole portfolio, or $100 million. I mean, it doesn't really matter. This would get you, if you're putting sleeves into this mandate of 5% or 10%, get the whole portfolio up to 105, 110 in terms of an asset allocation. And I think that the reason the ETF business is going towards this is because, and we have these conversations with advisors. I mean, I've been doing this for 20 years. Go into the advisor's office, they want to put that 5% sleeve into gold because they're at zero. And it's like, great. Here's my portfolio. I don't want to sell any of these other line items. Full stop. I don't want to sell any of these line items. I like what I have. I like my 60% equities. And you can manipulate your portfolio to make it 60% equities, a few percentage points in gold, keep the 40 in the ag, and essentially get yourself up to 105, 110 by putting some sleeves into the GDEs of the world. And it's at 20 bips. So
Yeah, pretty cheaply done. A lot of work.
Yeah.
Pretty cheaply done for you. Cash at 12% right now? Is that right? I'm looking at for holdings. Cash and cloud
well,
at 12%?
it tends to be about 10%. It tends to be about 10%, but it will be using that simply as the collateral for the gold futures. It's a very simple product.
Got it.
It's 500 equities. It's not the S&P 500, but it's like the S&P 500.
Okay.
And then you use the 10 cents on the dollar to get the collateral, and it's know what you own, right? I mean, like you get a day where the S&P's down, or the Russell 3000 is down, and gold is down with it. It's going to be a tough day for GDE.
Right. Like today.
Like today. I mean, I have to look at the tape. GDE's probably down considerably, so it's no surprises. We know what we own. It's a 1.8 for every dollar. But then if you have a situation where you have an up and to the right situation like 2025 for the broad market on the equity side, plus gold wants to do what it did in 25 and really in 24 and 23 as well, then the GDE type products and GDMN, which is the gold miners, those are going to go up to the right with it.
You're up at 78% in the last year.
Yeah.
For GDE.
Yeah.
So, and GLD up 76%, S&P up 17%. So when you think about kind of this hybrid tool, do you think for the everyday person it serves as is this kind of a ballast position, stocks plus gold, or if it's a balanced position, does that lean a little bit too far gold?
I think it's something where you can say, all right, I want to squeeze single-digit percentage gold into my portfolio. How do I do this? That's what this is. I think that's the best way to describe this. If you're taking GDMN, for example, which is the gold plus gold miners, now you are basically really being pot committed to gold, right? The first one, GDE, is stocks, regular stocks, plus the metal itself. So maybe one goes zig and the other goes zag. But with gold and gold miners, I mean, let's be logical. They're going to both go up and down together. So that one has more of a leverage to the precious metals complex. So you need to be bullish.
Miners already kind of a form of leverage, right? I got GDMN up right now, by the way. Love that ticker, fun one. Don't pronounce it too fast. You might get in trouble at church.
Yes.
A little bit more expensive, 45 bips. But you know, this is different for sure. I mean, I do think that the miners, for a lot of people, they add a little juice onto the trade, I guess.
Yeah.
And you also, is it going to lean a little international to some extent? You get some international exposure?
Yeah. When you're constructing a gold mining index, you have to do that. It's different from general equities because you are in a very specific sub-industry of the Russell 3000 if you're trying to pick U.S. miners. I mean, it's not much there. So yeah, it's going to be a global basket, and in order to be in it, you got to like gold because you know if you're sitting here at 5,100 and gold price goes down to 4,100, gold plus gold miners would have a more difficult experience than a general gold bullion fund or even a gold mining fund. So it's a classic know what you own, but I think it's a good way to get that sleeve in there of both of them together.
That's an important way to think about it, and I think a lot of people do want some form of that sleeve these days.
Yeah.
So it's getting a hit today, obviously, miners.
Yeah.
You know, that's kind of the roll of dice. The day you go on TV, the day gold's getting smacked for the first time. Kind of like the day you got 4 guests on a live show, and your machine breaks down 30 minutes before.
We don't need the machine. We
It
do
is.
it without the machine. We know what the chart of gold looks like.
We do it live. Jeff, great stuff. Like the context, and
Cool.
I think helpful too. New ways to think about gold and think about how to work it into the portfolio is definitely a challenge. A lot of people are trying to figure out right now.
Yeah.
Appreciate it a lot.
All right, Oliver. Absolutely.
Jeff Weniger, WisdomTree, GDMN and GDE are the tickers. Short break, and then we're coming back to close out this market to see if we can finish maybe with a bang. We've seen worse days for sure. You know, right now down 1%, less than it. The S&P 500, 68.18, trying to hold on to that line in the sand at 6,800. Scott Bauer is taking us into the bell next.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. I'm Oliver Rennick. We got about 11 minutes into the bell. I got the one and only Mr. Scott Bauer here with me on set. And we're trying, Scott.
We're trying. I mean, I don't know anybody that, even if we close right here down, 60 points, that wouldn't say this was a heck of a comeback.
Yeah.
However, today feels a little different than yesterday. I think a lot of the traders here, a lot of people I spoke with yesterday came in feeling like we were going to see a rally. It feels a little.
Me too. I was wrong on that.
It feels a little different today. That maybe this downdraft is a little bit more sustainable. Personally, I think that because of some of the relationship that we've seen with what are supposed to be risk-off assets, not acting like them today. Mostly, in my opinion, because of the rhetoric out of President Trump saying that the U.S. can go on forever. You know, it's not maybe the narrative of this is a couple days, a week, 2 weeks, that open-ended market's not going to like that. We're not, nobody's going to like
conflict.
Yeah, nobody's going to like that. But I think that seeing this divergence today between what oil is doing and then what it's doing to the bond market, what it's doing to gold, other precious metals, that tells me that this may be lasting a little bit longer.
The crude move is definitely notable. I can't let go of the long-term chart, which just it looks like a
It's
fade.
decidedly
at
bearish.
77 bucks.
I'm still bearish.
Okay,
I'm
so I'm
still
not alone on that.
No,
Though
absolutely
I,
not.
I
And
got my face ripped a little bit today.
yeah, I did too, and that's why you use stops. But
That's
you know,
exactly what I said
at-
on last night too. Is like,
that's
put
why
stop
you
at
use stops.
78, 80 bucks.
Absolutely. And the narrative still holds that, barring geopolitical risk, which obviously we're in the middle of a big one right now, the fundamentals haven't changed. There is still far, far more supply than there is demand. So how long is oil going to stay elevated with whatever risk premium you want to put in it? Is it $10? Is it $8? Is it $15? Who knows? But I agree longer term, I think that bearish narrative still holds.
By the way, 78 bucks was what I was thinking to stop. We got to 77.98.
Yeah, right?
Today.
We sure did.
77.98.
We
so
sure
I guess
did.
I'm still alive. All right. To your point on bonds, maybe the reason bonds didn't rally today is because we're thinking inflation implications.
No
from
doubt.
Crude.
Oh yeah, no doubt. Normally in an environment like this, when you see the risk off trade, you see bonds rally, rates come down, you see gold rally, other risk assets rally like that a bit, and we're seeing the complete opposite. And that is all because of an inflation concern due to the price of oil. Now, if the conflict lessens, ends, and we all pray it does for a number of reasons, we could see rates diving below 4%, probably going down 395, 390 on the 10-year, and we could see a massive, massive rally in gold if we see some easing of the conflict here. But yes, bottom line is oil prices stay elevated. That hurts inflation. We're already in this period where, inflation was working its way down a little bit, but still a problem. This could exasperate that.
We definitely don't want it, for sure. We don't want inflation problems. WTI, though, it's got this long wick on it today.
Yep.
But at least it's faded back down pretty significantly. I think volatility, too, we're kind of creeping back up here at the close. It doesn't look like we're going to finish strong. It looks like we're going to finish weaker than stronger. But this also could have been worse today. If you think about what people have labeled as potential World War III for years, it's Iran.
Yeah.
So if we drop 1% on, I don't know, man.
Well, where we are right now, there's so much we don't know, right? They had I think it was reported in the news last night, there was a 4.3 earthquake that was detected. So some were speculating maybe that was a nuke test. Who knows? There's so much out there, but you're right, Oliver. If this is how the market reacts, and this is, I don't want to say this is the worst it gets, we're in pretty good shape. I still think that underneath everything here, the market is holding in pretty well.
It held 68 even though it cracked it. Look, Brent and his SpotGamma did a really good job talking about how it just looked like we had kind of thin, or rather porous. It was looking kind of porous below like 68.50, But the fact that this hasn't turned into some big chase to the downside, some big squeeze of long positions. Again, the fact that I can look at this chart and say we're still hovering around this dotted line, I still hope that this resolves by VIX breaking down. But again, it's definitely, it's not going in our favor today.
Real interesting, because we talked about this last week. If you look at the last print last week where VIX came down to the line that you've drawn there, we talked specifically that day that if VIX breaks there, we could see the markets to all-time highs. VIX didn't break. It held its support there, and here we are. So sometimes the lines don't lie, right?
Amazing how well this line has worked.
The lines don't lie.
At this point, to my own frustration.
Yeah, exactly.
But if we can, to your point, if we can kind of get this major geopolitical event out of the way, I think the other thing that's interesting today that was brought up earlier but is worth mentioning again is that Bitcoin's actually doing fine today relative to stocks. Cloud, as Brent pointed out, cloud stocks are actually up today.
Yeah, maybe people were just saying, you know what, enough with that. Maybe it was a little bit overdone even on a day like this. And how about the midday bank rally that we saw?
SLF? Yeah, there you go.
Early this morning, JP Morgan was touching 290 almost, down. It was down about $6-7, I believe. Goldman Sachs, a $40 turnaround intraday here. So what that tells me is maybe they're not bottom pickers coming in, but maybe, again, underneath the surface here, things aren't as bad as people had thought they were, especially in the banks here.
Goldman rallying is good. XLF rallying, again, is good. Kind of touched the line I had and then came back down, but you've been talking about looking for XLF and financial strength, so outperformers today. Again, I do think that's a message of generally more positive than negative when stuff like cloud, which has been getting obliterated, stuff like Bitcoin, which is getting obliterated, actually outperforms today, because it suggests that maybe the other stuff that's down today was just kind of the next step of this rotation, perhaps. We clear some of that out. We clear out some of the index to stock vol.
Yeah.
You know, I could see us ending solid by Friday.
I want to put a theory out there. This theory is mine, okay? So it is nobody else's. The skew that we have seen here in the SPX, other indices over the last several weeks has gone decidedly bearish, where out of the money put skew is well more expensive than the out of the money call skew. That could be because long-term institutions that are holding long positions were maybe using that as a way to hedge their positions, paying up a little bit for that put premium, right? But still have that exposure to the upside. So to me, it's a trader's haven when you see that skew go out of whack like that. It's called a risk reversal. In fact, earlier today, I was looking at about 80 points, so just over 1% out of the money in the SPX today. Going out to Friday, the puts were trading around $30. The calls were trading around $19 for that equivalent length away.
Interesting.
That is a massive skew.
Okay.
That is a massive skew. Something people should be watching.
Distortion.
Yeah.
Right. Okay. And if you hold stock, if you've got a base level of equity, then if you're kind of long stock already, you use this to then kind of understand, all right, where am I getting the best bang for my buck if I want to speculate in addition? Because you're already long.
Yeah, you're giving yourself a stop out on the upside in case things do rally. Okay, you're selling that call, but you're also buying the protection on the downside.
Right.
And rather than just buying puts outright, which have gotten very expensive, you're actually doing this, you know, with such a skew here, and you're stopping yourself out on the upside. So that could be a way that a lot of big institutions that are just holding long positions in the market are looking to kind of hedge themselves a little bit.
A classic caller, basically, to some extent, right?
Could be.
Yeah.
It could be.
But the skew makes it a little not classic.
Exactly, and that's why
the idea of selling and then buying.
That's why the
selling,
traders
buying
here
downside.
and traders everywhere look at that skew. And they have ways to hedge that. You know, the risk reversal. You can hedge that. If I was a trader out here, I'd be buying that upside call, selling that downside put, and then selling S&Ps against it or whatever index it is, and kind of locking that in there. And it's an opportunity that doesn't come along this severe too often.
Skew plus vol. Plus a market that hasn't totally broken down and is at an important
Where are
level.
we? 60, same 62.
There's the bell.
I mean, that's
less than 1%, man. Less than 65
win,
points.
That's a win for the market today.
I think that is a win for the market. Long candle there, Wick. Before we go, what is this? Who knows the TA on this? Who in chat has got the TA for that? What is that? A bullish hammer or something? It's got to be something, right? I think it's bullish. You know, a hammer, nail, something. You know? Hey, there we go. All right, Coop says which more channels like that. Appreciate it. All right, thanks, guys. We are out of here. Scott Bauer, nice way to close it off for us there. Thanks for tuning in. Thanks for dealing with some internet surprises, but some great guests today. Chicago Future Finance back tomorrow at 2 p.m. Central Time. I'm Oliver Rennick. Scott Bauer. Have a great night.